Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. This is a big one. I'm going to get into it all. I wanted to start by looking at the bond market mayhem. Let me tell you, it's getting crazy to say the least. The second thing is the China market chaos. What's going on with China and why, I will show you. And the third thing is the recession turmoil, because when we see this one particular indicator, there's a recession that always follows after. So I'm going to give you all of that information and more. Let's begin. Let's start right here. You could see every time there's a Fed meeting, the markets are real wacky, to say the least. They're up, they're down, they're all over the place leading up into that moment when the statement comes out at 2 p.m. And that happens. So I did a video about that previous to this one. I got into all the details. I sat through the boring conference. I gave you what you need to know. So that's in that video. But for this one, I wanted to show you something specific, how the stock market generally reacts. And essentially, when they raise rates, and then this is no surprise, by the way, when they raise rates, the market does not perform as well as if they were to cut rates. And that's on the day, by the way. And that's, like I said, not a surprise. But in general, the market does well on Fed days. You could see that. If they are raising rates, if they're holding, if they cut, the market generally does do well. Now, what happens in the following days, the following weeks? Well, that's up in the air. It depends on the conditions at the time. I think a lot of people need to understand how we go through the history of this all. That's what this channel is about. It's documenting each and every piece of the puzzle. Jerome Powell, like I said, I talked about it in the previous video, but here he is. As I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability, and determined to use our tools to do exactly that. The American economy is very strong and well positioned to handle tighter monetary policy, making it what they call hawkish. And you could see that the intention is very clearly that they need to increase interest rates and they need to reduce the balance sheet. This is really important. Now, we don't know what's going to happen tomorrow. We really don't. Suddenly, they could have a change of heart. But at this point here, we still can't get people to acknowledge the fact that, yes, they did increase rates. I get it. But they did. Okay, just a small amount. And we still can't get people to agree on the fact that they have not expanded the balance sheet, or they will not be expanding the balance sheet, at least in this part of the cycle. So that in itself seems to be like a task. You can see here, Powell ramps up inflation fight in the economy tough enough to cope. I think people need to be paying attention to every single word and action coming out of the Federal Reserve. If you want to know exactly what's going on with the Fed, you can simply type in to a search engine Fed H41. So we have yield curve inversions that are taking place today. This is very important. It is one of the most reliable indicators of a recession, time and time again. We haven't seen this. This happens to be the 5 and the 10. We haven't seen this since 2006. Now, what does this mean? I've talked about it many times before. For anybody who needs a refresher, just put it this way, okay? Super simple. If you were to get a 30-year bond, you would expect that that's a big risk. It's a long period of time. So as a result, you would want to get, more compensation than if you were to get a 1-year bond, right? Makes sense. But now what's happening is it flips the other way, where the shorter term debt is going to give you more than the longer term. Strange, right? Well, that's when the markets are getting all messed up. It's kind of mayhem, if you will. Now, this happens on occasion. The fact is, when it happens, a recession follows. The time in between, that's debatable. Depends on the circumstances. Here you can see the 2 and the 10. This is the biggest, the most important, some would say. And it's almost there. Almost there. So we'll see what happens in the coming days. Bond traders stunned by a hawkish Fed are sounding growth alarms. Gap between the 5-10 year yield inverts for the first time since 2020. Debt traders brace for fresh losses as officials hike rates. You know what happens when they do this. The markets are going to look very different, the bond market and the stock market, because the stock market waits till the last second to react. That's just the way it is, okay? The bond market is real telling sometimes. Defying their stock market counterparts, Treasury traders aren't buying Jerome Powell's upbeat pronouncements on growth. In fact, in the aftermath of Wednesday's policy decision, one bond market indicator of economic hardship is flashing red for the first time since the darkest days of 2020. So, like I said, let's just understand that the market is pricing in a higher recession risk, and you can see that with the inversion between the 5 and the 10-year yields. That's what the bond market tells you. Does the bond market lie? No, it's manipulated, there's no doubt. But it certainly tells you something, tells a story, to say the least. You can see that right there. The 5 and the 30-year also heading in the same direction. Now, I wanted to point something out here. You could look at this with any of these combos, okay? 5 and 10, 5 and 20, whatever. As you see here, after the financial crisis, up until this point of 2018 into 2019, it was heading down. This was happening. It was going to be a yield curve inversion. Some of these got real close. And then you see things changed, right? Well, I believe what was happening here is all based on the stimulus, the TARP bailouts, the QE, everything during this financial crisis period. Okay? And then that steam kind of ran out. Okay? All of that. And brought us to a point in which we were headed towards a big event, some sort of recession, something. And then we hit the beginning of 2020 and things got real wacky, as you know. So I wanted to make that clear that this was already happening from years ago. The problems we face today are not because of 2020. They're because of 2008, 2009. Look at this. This is real important. Fed funds rate versus the CPI. People say that, oh, they can't raise rates. They can't do this and that. Look, these two are generally moving in lockstep. But once we got to this point during the financial crisis, inflation took off. I mean, their measure of inflation, it rose, but interest rates never did. And then you look at where we are today. There's this huge chasm in between the CPI, the fake level of inflation, and the Fed funds rate. Now, what's going to happen here if inflation continues to rise? Is it, or is inflation going to come down and interest rates can come up just a little bit? I've said this many times before. I believe that the rate at which interest rates become a problem, or the Fed funds rate becomes a problem, is somewhere between 0.75 to 1%. This is based on a simple crude drawing of previous cycles. Like literally, if you take the peaks of all of these cycles coming down, 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 you get to somewhere in that range. This is not scientific at all, okay? But that's the way I see it, okay? And so let's quickly take a look at what's going on in China. You could look at all of the people today and see what they had to say about China. You could look at the Hang Seng Tech Index, which the couple days before dropped by 30%. Now that's ridiculous. There's no doubt. But then, so this is actually what you're seeing here is 2 days before the day you're watching this. So the market jumped. Record one-day jump after record losses. So record losses, record jump. And again, as I am recording this video, you're looking at it up basically 6%. 6%. Unbelievable. Here we have it. Optimism has swept investors after China's top administrative authority said that it would work to stabilize Chinese stock markets and boost economic growth in the first quarter with, quote, concrete actions. Now, did anything happen? We don't know. We don't know if they did anything, but that's at least on its own considered to be forward guidance. So they came in and said, we will do anything. You know, Draghi said the same thing back in 2012, right? You remember that. Mario Draghi, we will do whatever it takes. You know, the Bank of Japan has said that about 10,000 times as well. China makes strong vow to ease crackdowns after market turmoil. So you got the vice premier coming out and saying, oh, you remember the reason why Chinese stocks have been crashing nonstop? Oh, we're going to stop with that stuff. We're going to stop the crackdowns. So all of those companies, Alibaba and so on, that have been beaten down because of the crackdowns and had consistent worries, don't worry, you're going to be okay. Is that the case? Like, really? I don't know. We'll see. I'll keep an eye on it. Here we go. This is really what I wanted to conclude with. I got a few things to show you. So this is kind of a deep conclusion, to say the least. If you want to support this channel, simply hit that thumbs up button, okay? That's all I ask of you. The Fed is suffering from blissful ignorance. How can they expect to dramatically raise rates in the next 2 years, I think 10 times for this year and next year in total, but they don't expect the unemployment rate to move higher? They expect economic growth to not be impacted that much, essentially saying what Powell had said during the conference was basically that there are so many jobs open, there's so many people out there that have an abundance of cash that there isn't a worry. So we'll see what happens, but that's what he's talking about. Right now, the financial conditions are at 2018 levels. They're getting tighter. It's not just Fed funds rate, though that is part of it. When you look at the markets in general, you look at the way that, you know, mortgage rates, I mean, there's so many different factors. And you could see that other than that huge dip downward during 2020, this is becoming tighter, to say the least. Now, you thought what was happening with the energy markets, with commodities, was only going to affect some people. It wouldn't reverberate. Well, what about if they are considered to be too big to fail? What if they ask for their own bailouts? Well, energy traders call for emergency central bank intervention. Here we go. More QE? We'll see. Trade body warns healthy company could run out of cash as Ukraine invasion sparks commodity ructions. All right. So they get into the details here in this Financial Times article, but I think it's important to understand the fact that what we're seeing, this disruption, could create big problems. I talked about the margin calls. I think it was in the previous video. I had to cut some out of that previous video because it was going on way long. But understand there are margin calls that are taking place today. Specifically, this company here, Trafigura, is affected by this. Okay, looking at all of this, you have to understand the counterparty risk. What we saw with the subprime wasn't because of subprime. Like I think that it's really misguided. If you read through it and look at the data and don't just, you know, there's some movies you can watch and stuff that's great. It really is good, but you have to look into it on a deeper level to understand why the counterparty risk. Okay, I'm not going to rant on. This is just showing you the liquidity erosion that's taken place. This is oil specifically, and looking at what has happened here, you're noticing that the liquidity everywhere, not just with oil, has been diminishing, which is why you get these exaggerations. So the oil right now, I mean, as you're watching this video, it has gone up, but I mean, it's almost $97 a barrel. But looking at that just gives you a little bit of insight as to what's happening. It really accelerated, to say the least, okay? Cannot stress this enough. There's credible estimates that suggest that Ukraine's yields in 2022 may be reduced by half. Even a 10% decline in production would have massive implications to world hunger and global stability. Food security is national security. Watch this very carefully. I'll talk about the food riots and why I think it's important for you, the individual, to have your own food security, at least to a limited degree. This is important as well. Don't go anywhere. Okay? Real key. Russia, gold. You want to know about that? I got something to show you. If Russia gets desperate, it could sell bullion domestically to buy rubles, Citigroup said. If done at a fixed price, that would be tantamount to an internal gold standard. Quote, if things get worse, you could basically re-anchor to a pile of gold. Who's that? Zoltan. That's right, Zoltan. One of probably the most accurate people in the financial industry, at least over the last couple of years. Quote, you need an anchor in situations like this. So I just want to show you all of that and really bring us back home. What's going on today? We see the markets going and tipping over, getting real exaggerated. Liquidity is falling. Stocks are up, stocks are down. Bond market's going like this and that. Everything's getting wacky. So that's why we have to look at, if you're an investor, if you have investments, look at where your money is. Start to really acknowledge what you think is just going to be, dead weight. You can cut it off. You can put the money where you think it's strong. I can't give financial advice, but just simply be real prudent right now, more than ever before. Recession risk, it doesn't come overnight. That's the thing. These type of things take time to develop. So we watch the indicators, we pay attention, and we do our best. If you found the video informative, hit that thumbs up button. That's all you gotta do, support the channel. If you're not subscribed, hit that button as well. I'll see you on the next one. Take care.